Hello and welcome to a special series that we're kicking off ahead of the Union Budget in 2021 on Mint. This is a pivotal budget and moment for all economy and economic policy watchers. As India closes up this year, we are in the throes of a technical recession. It is true that there have been very nascent signs of growth cropping up across the Indian economic landscape. Equally, though, it's true that at this point, every step matters and every step is crucial. What should the finance minister consider and what might be the key imperatives as we aim to build back this economy? Could 2021 be the make or break moment for us? That's what we're going to discuss over the course of the next few conversations. The first one today is an extremely interesting one and one that brings out a very wide range of opinions. Should India look to open up its economy? Should it look to get back into the global track and actually start pushing harder on exports? Or should it go with a track that it's moved to in the last couple of years, where it's become more protectionist in nature? The Atmanirbhar scheme, of course, will be a key focal point for the budget. But will that be the track that the finance minister chooses to take in an environment where she needs to scale up India's economic prospects and growth, of course? Joining me to debate that and to talk about that is an all-star panel that knows this subject and many others around the economy fairly well. Let me introduce them to you. Saon Ray, who's Senior Fellow at ICRIER, joins in to talk to me. Santosh Pai, who's partner at Link Legal and understands the landscape with respect to the India-China imperatives very well. Ajit Ranade, an economic face that needs no introduction, President and Chief Economist at the Aditya Birla Group, and Samiran Chakraborty, who's Chief Economist for India at Citigroup. I welcome all of you. Thank you for joining in. Let me dive straight into it. Dr. Ranade, first word with you. I want to take a couple of steps back to February 2018, where the then Finance Minister Arun Jaitley rose to present his budget. And within that, they lay a surprise. There was a much more protectionist nature to his budget. In fact, if I have the number correct, there was a customs duty raise on as many as 46 items. I want you to walk us through that period in 2018 to where we are now in terms of whether or not you think those decisions have done something good or have made a major step forward either for manufacturing or for India's export potential. I think you'll have to unmute yourself, Dr. Ranade. Your audio isn't very clear to us. Yeah.
Thank you, Mitali. Thank you. That speech which you mentioned of Finance Minister Jaitley was in the context of growing for protectionist sentiment or growing protectionist actions all around the world. And there was some unilateral action, as you remember, from the US on which slapped tariffs and raised tariffs pretty steeply on imports from China, which they subsequently expanded to other countries as well, including the European Union. And there was a tit for tat action from China as well. So it seemed as if the world was entering into a somewhat more protectionist phase. Of course, partly concerned because of the domestic employment and industrial situation. And in India, also, I think what is happening is that, as you know, the trade remedies that we have been using, and especially for countries where imports are coming into India at below cost of production, and that trend was increasing, and therefore, and the remedy for that was anti-dumping duties, which is actually a quasi-judicial procedure that you got to demonstrate, you got to give evidence, there are hearings, there are counter hearings, and the whole process takes 6 to 9 months. There are, of course, other remedies available which don't take as long. So the context was that of raising. But indeed, it was somewhat of a surprise, and economists, of course, were not exactly enthused because the long journey of steadily decreasing tariffs from early 1991, I think we saw this was kind of a reversal. And I believe from 2013 onwards, not just 18, if you look at the last 5-6 years, the overall average tariffs have gone up by 5 percentage points. So it's not only that speech, but that trend has been seen over the last 5-6 years. And that is, I would say, a little worrying because all said and done, India's exports also have an import content. So to the extent that when we increase import tariffs, We also make the production of those export items to the extent that these imports are on intermediate goods which go in the production of exports. To that extent, also there's an increase in cost of production, and therefore it can be it can be like a de facto export tax. So we have to be
Mm.
careful and selective and strategic about these protectionist actions.
Sharon, let me draw you into this conversation, on exactly the point that Dr. Ranade raised, which is that an import tariff is basically equal to an export tax. Do you get the sense that there is going to be a major pivot from that stance for the finance minister or for this government going into next year's budget?
So the thing is that imports, if you look at our basket of imports, a large part of it is actually intermediate imports. So the point
Correct.
that Dr. Anandi was making is that if you increase the import tariffs on those items, we are actually making the goods more expensive and hurting your competitiveness in a market where you are already not being able to compete with some countries and some goods, like in garments, you're not being able to compete with Vietnam or China, with Bangladesh. This is a bad thing. But then, see, India has always increased its customs duties through its budget, and usually it is done in a manner that if there are certain industries which are getting hurt adversely for some reason or the other, this is how it is done. So it is possible that certain industries might get protected in the coming budget also through this means.
Which industries would you immediately identify, Shayon, as those that might get addressed in this budget?
So also, if you look at the PLI scheme which has come about,
Yeah,
it has already talked about protecting 10 sectors, and of all the schemes that of all the sectors that have been identified, particularly I think textiles stand out because there is need for some protection as we make more and more PPE and those kind of items. So it is possible that these sectors might get protected.
Samiran, what form and shape do you think the narrative might take this time round? Because I'm quoting from what the principal advisor for the Department of Economic Affairs has said, and he says, and I quote, "Atmanirbhar Bharat scheme is not to be mistaken as an import substitution policy." It tends to be seen as that. How do you think the two can deviate? Can we have the best of both worlds, where we are trying to create this kind of space for domestic manufacturers, but we also have international aspirations or global aspirations via greater exports?
So I guess the question really is that what's different in this import substitution versus the pre-1990s import substitution, which we all economists are worried about because we have well documented that that pre-1990s import substitution led to a lot of inefficiencies, which
Correct.
pushed our growth back, right? So I mean, my view, what is changing is that while the trade account, the government is becoming selectively protectionist, and I'm using the word selectively and tactically quite consciously. But on the other hand, the capital account is becoming more and more open. And I think that's the counterbalance that the government is looking at. That if the domestic industry becomes inefficient, complacent under the tariff umbrella, then there's a potential of takeover by global companies. And that threat of takeover would not make the domestic manufacturers become inefficient despite the tariff protection that is being given to them. As long as this model works, it's a very interesting combination that we are trying. But there is always that fear that once you are on this path, there's a slippery slope, and the demand from more and more industries will come in for these kind of protections. And once you combine that with the fiscal incentives that the government is giving, then the overall protectionist tendency would become even more than what the simple tariff and non-tariff barriers would suggest.
Mm. Santosh, this is a good and opportune moment for you to jump in. Much of this narrative has also been built because of escalating tensions between India and China. But if you had to look at the numbers, India at this point accounts for only 3% of China's exports, less than 1% of its imports. Um, in contrast, though, a lot of the imports that come in are extremely essential for Indian industry, whether it's pharmaceutical ingredients or more recently, as we saw, there is a shortage of semiconductors. It affects the auto industry as well. Are we going about this the right way in terms of combating or taking on the Chinese dangers as we see them?
Thank you, Mitali. So, as Dr. Ranade was referring to, we have been using anti-dumping and such measures to guard
Yeah.
against the real risk of dumping from China, and that's perfectly valid. Every country does it. But what is important to watch out in the forthcoming budget will be in 2020 we did a complete U-turn when it comes to our economic engagement with China. Until late last year, we were actually looking to expand economic engagement, welcome Chinese investment, enhance trade, and reach $100 billion target. Now, all of that has gone out of the window. So, what will be interesting to see is how do we prioritize economic growth for India over our political tensions with China? And that is a very careful balancing act. We can't just become inward looking and protectionist because that's not going to help us when it comes with the rest of the world. At the same time, we have to reduce our dependency on China. That's a real requirement. And we just talked about the production linked incentives. When you give such incentives, you offer them to your domestic companies as well as foreign investors coming in to make India their manufacturing hub. So it's really this balancing act for the entire global audience will be watching out for in the forthcoming budget.
Hmm. Dr. Anadi, even as we aim to or hope to build domestic manufacturing, it is a truth, is it not, that growth and exports for any emerging market economy are Siamese twins. They have to go together in order for us to achieve or even aspire to get back to that percent growth. In that context, do you think India is doing enough in terms of boosting its exports? And do we have a real sense of how to leverage that opportunity over here, given the landscape that Santosh just pointed out? I mean, it's not just India versus China. There is a very real sort of fear around engaging with China economically or otherwise for other nations as well.
Well, Mitali, just to add to what Santosh said, the import dependence on China, let me just give you some numbers. In
Yeah.
electronics, it is 45%. In capital goods and machinery, it is 32%. In organic chemicals, it's 38%. In furniture or bedding, which is an end consumer good, I guess, it's 57%. But in automotive parts, it's 25%. And pharmaceutical intermediates, like you mentioned, 68%. In
Yeah.
some items like compressors for air conditioners, it's 80%. I'm told the motors for washing machines is 90%. These are all inputs, intermediate goods. So there's no way we can build this capability overnight. And remember, in pharmaceuticals, we are actually a big exporter of bulk drugs. In fact, 20% of the global share. And this is a success story because we have been able to meet the requirements of the various regulators, like the food and drug regulators in North America or in Europe. So we source the ingredients from China, but we are the ones, our companies are the ones which win the regulatory approvals. And to maintain that edge, what we just simply can't switch off the inputs from China. So you're absolutely right that export success is inextricably intertwined with domestic industry and manufacturing success. There is no country which can achieve industrial production at scale and increase its share of manufacturing in GDP without simultaneously and concomitantly doing well on exports. And in fact, unfortunately, the numbers on exports are not exactly inspiring. If you look at our total merchandise exports back in March 2014 for the previous financial year, it's the same 5 or 6 years later, about $300 billion. And this is not a time when the global trade was not growing. And around the same time scale, around the same time, countries like Vietnam, Bangladesh, even Sri Lanka, Thailand, South Korea, all have clocked very impressive growth rates in exports. I'm not even mentioning China, which of course has done well. So there is something we need to look at. And by the way, apart from import tariffs as a protection to promote domestic manufacturing or exports, which, as I said, if it's going into intermediate goods, it's like a de facto export tax. One very, I think, across the board instrument which works well is to ensure that your exchange rate is competitive. I believe our exchange rate has been overvalued, and this is not just me. I think the Reserve Bank of India statistics also show that. So if we were a little more alert about that, a 5% depreciation in the exchange rate across the board is equivalent to like a tariff protection of 5%. So we have ignored that one particular important instrument of contributing competitiveness. And there are, of course, other export promotion measures, but this is one, I think, one important element in our export strategy.
Samiran, let me get your thoughts in on that, specifically on currency, because I know you've kept a very careful eye on currency movements. Do you agree with what Dr. Ranade just said? And do you think that the time has come to create a shift, at least in terms of how we approach our currency, if not how we are approaching our export policy?
So our analysis seems to suggest that imports are more responsive to the exchange rate than exports in the Indian context. There could be many reasons behind that. One of the reasons is, as Dr. Ranade in the beginning was mentioning, that a lot of exports have imported components into it. So in a sense, the exchange rate then becomes a pass-through for them. But the bigger question that we are all grappling with now is that even if for the moment we can't go back in history and change our exchange rate, but looking forward, our estimate is that for the next 4 to 5 years, the current account deficit, which over the last decade was averaging 2.3% of GDP, is going to be less than 1% over a 5-year period consistently. That kind of a structural improvement in current account, combined with huge amount of capital flows that we are getting, would mean that the balance of payment surplus is going to be somewhere between 65 to 80 billion dollars every year for the next 5 years. How do you ensure that your currency is not appreciating with that kind of delusion balance of payment surplus? Is, I think, a massive policy challenge that we will be grappling with. It's obviously much easier to say that we should have a relatively undervalued currency if we want to follow this path of partly import substitution and partly export promotion. But to deliver on that is not going to be easy given the kind of BOP projections that we are making right now.
Shayan, I want to sort of, shift this conversation a little bit to what the thrust of what we've been hearing from the government is, which is basically that they want to push manufacturing. We've heard that by way of what they had to say for the PLI scheme as well. 25% of GDP or so is the target. But if you looked at the numbers, and even if you sort of, refix the target for a decade from now, for 2030, is import substitution really going to do a lot to muscle up manufacturing for us? What's going wrong with the nerve center of manufacturing in India? Because it has actually been on the decline, since 2012.
Yeah, so in the manufacturing sector in India, in terms of employment, it has not grown. In fact, for the last uh, 30, 40 years, it has in fact remained stable at about 18, 19%. But in terms of value added, it has definitely grown. And when we compare numbers, we sometimes miss this point that we have, in fact, manufacturing strength, not in low-skilled manufacturing, which countries like some of our competitors are always pointing out. Vietnam and Bangladesh typically. In garments, we don't. But we do have competitive manufacturing in very many sectors. Automobiles, for example. Pharmaceuticals, for example. We are suppliers of generic drugs to the entire world. So it is the problem is that as far as manufacturing is concerned, we've not had a consistent policy, and definitely import substitution is not going to help. Now, the reason why we have not been able to push up manufacturing is also linked to the fact that we have not been able to integrate into the global value chains, the regional value chains of Asia. And again, there basically, so if you, the importance of imports becomes very important in that. In order to export, you need to import. And because if you're part of the chain, you're importing certain things, intermediate imports, and then you are processing them and then exporting. If you are part of the chain, then both your imports as well as your exports in that product will be high. Diamonds, for example, India processes a lot of finished diamonds. We are importing the raw material and exporting them. So there are certain, I mean, in fact, gems and jewelry is a very important export earner for us. But the main issue is that what are the low skill manufacturing that we can encourage? Because therein lies the problem of solving our employment. So we don't have to see this only in terms of, you know, what we can do in as far as sophisticated manufacturing, which we are doing actually very comfortably and very well. But the problem actually lies in scale, and there the usual problems, you know, land, labor regulations, etc. Everything is there. But as far as encouraging low skill manufacturing, we have to really think out of the box. And I don't think, you know, any kind of import substitution policies is actually going to help in that case. We have to find a way to becoming more competitive compared to our competitors.
Santosh, Saon raises an important point though. Are we overthinking this debate about automation and, you know, how India can get a foot into the door? Are we ignoring the more labor intensive, low hanging fruit, as it may? At this point, from the data we have from China, which is limited, albeit it looks like real wages are rising, the working force is actually shrinking. Is this not a clear opportunity for India to tackle two impediments or two challenges? One, to create greater employment, and two, to actually get into this kind of labor intensive industry and hence become a global, you know, spoke in the entire wheel?
Yes, Mitali. I think you started this sort of segment by saying, the signals that the Indian government is sending. And if you put yourself in the shoes of a global investor today, you're getting terribly confused because the stated objective of the Indian government today is to take advantage of the backlash against China and present an alternative manufacturing destination. But at the same time, we are not a part of the global value chains. We have just stayed out of RCEP late last year, and there's not likely going to be a rethink on that. So, for a global investor who wants to come to India, there are three questions. You look at feasibility, profitability, and also the ease of business. Now, admittedly, we are doing very well on the ease of business. We have, zoomed up the rankings because that is, possible. You can do it with a few tweaks. But the real feasibility, as we just discussed, the scale at which we need to manufacture to consider ourselves a viable option for as a global manufacturing hub, that is where we are really struggling. Even the foreign investors who have entered India in the last 5 to 6 years cannot scale. They either find it difficult to recruit the right type of talent in terms of workers and skills, or land acquisition, or logistics within the country, the demonetization, the GST. So there were reforms going in the right direction, but it needed time. But this year, a lot of these global investors are going to rethink whether India is still going to be progressive and be reformist, or is there a change in thinking? Because this needs an absolute crystal clear political commitment. We can't dilly-dally on a year-to-year basis. You need to actually make attracting FDI a national priority. If you need to succeed, you need to eliminate overlaps. For example, a lot of states compete in the same sectors trying to attract foreign investment. Special economic zones. I mean, there's a huge debate around that. More than 50% of our special economic zones are IT parks or IT companies. So there's a lot we can do to improve the ease of manufacturing to make India a viable option on the global stage.
By the way, halfway mark into our conversation, I must tell our guests as well that there's questions that are pouring in. So I will be throwing a couple of curveballs from our viewers to you. Be prepared for that. Dr. Ranade, on the point that you were making about India versus where it sits in Asia, you're right. I mean, at this point, we have trade deficits with pretty much every country in South Asia. And I cannot have a conversation about India's export potential without discussing the very prickly RCEP. Do you think it was a missed opportunity for India, or do you believe that India is waiting for a more opportune moment to get into that kind of agreement? Dr. Ranade, is my voice reaching you? Yeah, I think you'll have to unmute yourself.
Oh, I'm sorry. Sorry. We already have a free trade agreement with 10 members of ASEAN. We have a very aggressive trade agreement, free trade agreement with Japan and with South Korea. A free trade agreement with Australia and New Zealand is in the works. And RCEP was not any way more ambitious. In fact, one of the conditions of RCEP is that it will not exceed the free trade obligations already under the free trade agreements with ASEAN. So therefore, that's the first point to remember, that RCEP is just an incremental step in above the already existing pre-existing free trade agreement. Secondly, India has been involved in the negotiations for 8 long years. We started it in 2012. Okay, and thirdly, uh, the sectors which were of concern, like milk, we pride ourselves that we are the largest producers of milk, 188 million tons, and we are 20% of the world's production. And we feel threatened and insecure that New Zealand milk is going to come and flood our market. You got to really examine this issue. We feel, the main threat was about Chinese imports into India. But there were so many provisions of backloading. The completely zero tax regime, zero import regime can be backloaded, can be incremental. There are negative lists. So what we have done is, by not being part of RCEP, we have signaled, and this is where I think Santosh's point is important. It's not only about imports and exports. It's about the fresh investments into value chains. If I'm an investor, I'm going to have value chains which are going to straddle national borders. If one country is going to be out of that free trade zone, I'm going to think twice about locating some part of the value chain in that country. And this is the important part about manufacturing strategy and exports, that it's no longer about finished goods or import substitution. We have to be an integral part of all the value chains, whether it's electronics, chemicals, special chemicals, textiles, leather, everything. There may be a lot of automation which is coming, but value chains are going to proliferate. And by not being in RCEP, we are missing the opportunity of investments coming into value chains. I think my short answer is we should still, the door is open, and we can address the concerns of the main concern is about China. We can address that concern, and I think we will stand to benefit. Especially, don't look at imports and exports. Look at the investment opportunities also.
I have a follow-up question to that, actually, Dr. Ranade, because many economic policy watchers, people who have been part of government and policy formation, also root the fact that India was missing its opportunity to stand up to China, because a lot of the other members within the RCEP felt that getting India in would be a counterbalancing force where India could actually speak out against policies that seemed too heavily leaning against China. In that as well, do you think we missed an opportunity to really come up and stand shoulder to shoulder with our neighbor?
I think so, Mitali. Two important developments have happened since we walked out. One is that I think Mr. Biden is going to be the president of the US, and therefore the US may have a rethink about its walkout from TPP, the Trans-Pacific Partnership. So if the US walks back and into that 12-member, very very aggressive free trade agreement. Secondly, in the Quad, we have this new notion called the Quad, which is a geopolitical construct of 4 nations: India,
Yes,
Australia, Japan. But Australia and Japan have already joined RCEP, and they're members of the TPP as well. So India gets isolated there. We are neither part of any major trading bloc or TPP or RCEP, and US is now going to be much more. I think the trade negotiation, US going to be US China trade tensions will continue, but I think we will see a different trajectory of that relationship. And even at the height of trade tensions, even at the height of Mr. Trump's saber rattling, the US China bilateral trade was $660 billion, $660 billion. So I think we need to really think about, and incidentally, this mercantile is thinking of bilateral trade deficits I don't think the right way to go. We do have, for example, we should think of India, China, and USA. India enjoys a $30 billion trade surplus with the US. Surely the US should not start thinking about, cutting imports from India. So, it's so we need to balance it out on a multilateral basis, and I think that's where. But of course, not escaping the fact that our exports need to really grow at double-digit dollar terms that we saw until 2012, 2013.
Yeah. Samiran, come in on that because I know that you track the free trade agreement space as well. And increasingly, there is talk of looking at this a different way, more aggressive regional cooperation while also trying to do good for your own citizens or your own manufacturing. Do you think that might be the best way to speak up to belligerent countries, not just China, by entering more free trade agreements, by getting into these kind of regional or as, Ajit was mentioning, a quad kind of, collateral understanding?
Yeah, I think as was mentioning what is changing, clearly what is an optimistic, what we will be looking for is that the in the last 6 years, if you see the elasticity of global trade to global growth, that elasticity was falling very rapidly. So one plausible argument could be that multilateral institutions like WTO, their powers were on decline, and that was leading to this sort of protectionism across the world, where global trade was declining, say, vis-a-vis global growth. Now, would that be changing under the Biden administration, where maybe these multilateral agencies will have more role to play? The dispute settle mechanisms will be working better. So if WTO gets revived, then the chances of global trade returning back will be probably stronger. In fact, just as an aside, I think once we are coming out of this post-COVID recovery, we are finding a surprising pickup in global trade, which no one was anticipating. In fact, a large part of the global growth surprise is being contributed by the global trade surprise. So if this trend continues into the next few years, then the chances of these regional cooperations will also succeed. Because unless the global growth tendencies change, I don't think at a regional level you will get much traction in getting into different sorts of trade agreement. Once these things start, then maybe the India-EU trade pact, the India-UK trade pact, the India-US trade pact, these are all very large trade negotiations which have been somewhat halfway done. And that way, just getting out of RCEP might not be the end of the road for India. There are still very many opportunities left to be exploited.
Glass half full for Samiran. Nice to hear that. Let me shift to a couple of questions that are coming in as well. And Santosh, maybe you would like to take this one. It's a question from Aditi. She says the government has said that the PLI scheme will be extended to laptops and tabs. Is it a good idea to extend this scheme to other sectors as well? And before you answer, I just want to present a little bit of data, which is this, the ISI in the electronics industry as well, Santosh, was started about 6 years ago. Here's the numbers I have, which is that imports of electronic goods shot up from $32.4 billion to $55.6 billion right up to 2019, while exports have actually inched up at a very, very slow pace from $7.6 billion to $8.9 billion. We haven't been able to build, a technology company or a mobile company of really large global scale. Can we do that with a separate industry like laptops and tabs?
Thank you, Mitali. Yes, I think this is a good question because India's experience with such incentives hasn't been really good. We had something called the MSIP scheme for electronics, and the uptake wasn't really what up to mark. So, and this is a very expensive way to promote manufacturing by giving capital subsidies and tax incentives and so on. The real challenge is we need to focus on the bottlenecks, which again we go back to skilled labor and land and so on. So I think yes, of course, we can extend it to as many sectors. There are already 10 sectors in play which are going to get incentives. There might be a little more coming in the forthcoming budget. But the real question we need to do is it competitive? Is it globally competitive for us for anyone to come, whether it's a domestic company or a global investor to come into India, pick any of the sectors we consider important for our economy and manufacture in India in a competitive way? That's really the key question. Because if we can't give a convincing answer there, then we are just going to sacrifice our economic growth, which is, I think, very important for the sake of political and geopolitical considerations, which have their own place. But in my sense, the priorities need to be clear, because in the long term, economic strength is actually the only way you can build up your geopolitical strength.
Mm. Shayan, is there a lot of deep digging that we need to do in terms of, what's happening with our industry per se? I mean, basically the question I'm asking is, do we need to move from flyweight to the weight boxing area? I mean, if you look at what's happening with the manufacturing workforce for exports, for example, almost 60% of that is actually employed in firms with very, very few workers, 5 to 10 workers. How do you take on, very large export ambitions when you're still working in such a small playing ground?
Absolutely. In fact, this has been one of the main problems that we have faced, that the size of our enterprises, I mean, the so-called missing middle, it has been talked about that our sizes are very small. I mean, even the largest firms in India are small compared to, global scales. And the other issue is that a large part of our manufacturing is also still in the informal sector, and it is completely not only unregulated. Access to credit is a problem, reaching export markets is a problem, uh, everything is a problem. And as we saw at, in post lockdown, these were the firms that were most affected, but they employ a lot of people, and we have to think about how we need to, I mean, there has been some credit guarantee that has been promised as part of Atmanirbhar Abhiyan, but has it actually reached the intended beneficiaries? What has been the uptake of that? And actually, do we see the industrial sector activity coming back post COVID? There will be definitely some losers in the process, but we have to assess who these are and sort of help such firms and rebuild the industrial sector. So right now it is in shambles. It's only, in fact, if you've seen the estimates that have come as far as labor is concerned, most of the large firms have retained their labor, but that has not been the case with small firms, which means that post COVID, many of them may have shut shop, and many of them may not come back to production again. So it's a grim picture, I think.
Mm. Samiran, you want to come in on that? And I also want to ask you that question, sort of layering it with, what your sense is on what's happening interstate, because that observation has been made. I mean, Santosh was making the point about how, states are bidding basically for the same item, but also that there is a huge divergence in terms of policy from one state to the other, incentives from one state to the other. Is that damaging India as a whole?
So first on the labor market issue, I think it's a standard structural problem in India that we are seeing what I call a reverse Louisiana model, where rather than people migrating from rural to urban jobs, in last 5 years, we have seen people migrating from urban to rural areas. Rural jobs have gone up by almost 40%, while urban jobs have remained practically flat. Uh, and that situation is going to stay like this even when we get out of this COVID situation. The area where I'm slightly more optimistic is that I think the labor market dislocation post-COVID has been not as bad as I feared, particularly as Shaun was mentioning that for the organized sector, we find that for about 4,000 farms, their wage cost actually has gone up by almost 3%. You would have expected this wage cost to come down given the kind of shock that we had witnessed. So if we get back to about 10% wage growth, which is the normal over time, then maybe the situation, the permanent scarring of the economy will not be as bad as one was anticipating. My only fear is that whether COVID is going to lead to more automation and digital things in the normal manufacturing and service processes as well, which would mean more pressure on the labor market. But coming to your other part of the question about the states and the divergence across states, I think one point which we should have discussed even before is the whole issue on whether India is ready for engaging in trade agreements with the rest of the world, ready to go in for exports. Why I mean bringing this point is that there is a good literature which suggests that our productivity levels have not yet reached a point where we can get into this kind of agreement, particularly because it will always be the case that our domestic market size will be much larger than the domestic market size of our countries with which we will be doing these agreements. Even if it's a regional agreement, still that will be the case. So it essentially boils down to the state that if they're able to make their state competitive enough, if the infrastructure is ready in that state, then maybe those states will be able to get into what Santosh was referring to as the special economic zones. So the special economic zones can flourish in those states where the infrastructure side is more ready. And you could have those export hubs located there. That way, the problem that we are currently facing of India-wide productivity being much lower than where we should be, that problem to some extent can be addressed. But at the same time, I can understand your concern also that if all the states are offering multiple sort of incentives, then sometimes for foreign investors to set up its facilities in India, it could be a very complicated process to decide on where that person needs to go.
Hmm. Dr. Ranade, I'd be interested to hear your thoughts on this. Samiran is challenging the truism that foreign demand will always be bigger than domestic demand. We should resist the allure of the domestic market. Do you agree with his point of view? We should kind of sort of build our house within, or do you think there will never be a good moment and we have to strike out to find out whether we can or can't float?
No, I think you were saying the other way. In fact, I disagree if we don't want to do trade agreements because our own domestic market is big enough. See, ultimately, what matters is not the numbers, but affordability. Our
Correct.
per capita income is $2,000, and we want to make goods and services where the I believe the total demand will still not be adequate to meet the. If we want to aggressively take our manufacturing share of GDP from currently 17% to 25%, which is a stated ambition, then to absorb that capacity, domestic demand is not going to be enough unless our per capita incomes go up to $5,000 or $8,000, which means that the residual demand has to come from abroad, the foreign consumer, the foreign customer. It could be in Southern Europe, it could be Spain, it could be Portugal, it could be Turkey, it could be the US. So to that extent, we need to tap into those markets, and exports and manufacturing, as you said, are intertwined, as I said, and that will lead to higher income. So there will be a time in our growth when our per capita incomes will be large enough to absorb most of the manufacturing domestically. But we are not there yet. So that should be the strongest reason why we have to engage very closely with the rest of the world. And by the way, our share of global exports, as you said in the I think opening remarks, is quite small. So whether global trade is expanding or not, to go from 2% share to 3% for us is a 50% growth.
Big jump,
And
correct.
it doesn't move the needle for the global market. So let's be aware of that. And also, one more point, Mitali, that we need to also learn from our own successes. We did have, you mentioned mobile phones. We did have the world's largest mobile phone factory in India. 35,000 workers, most of them women. World-class quality, special economic zone. The company was called Nokia. And it produced 500 million handsets in about 5-6 years.
Yeah.
It's not
I
like the iPhone factory, which is just producing maybe 100,000. I mean, no disrespect to them. We are talking about 500 million handsets produced in about 6-7 years. Nokia's biggest factory was in India. We forget that fact just 10 years ago. Why can't we learn from our own successes, and also what made it? What did we do to force it to close down?
I like the way you
Mitali,
phrased that, Dr. Ranade. It sounded like, economic fairy tale. There once was a company called Nokia, but please, Samiran, you wanted to make a point.
But I was just saying that I think I could not express myself clearly. My comment
Yes, I'm
about
sorry. Maybe I
domestic demand
misunderstood.
was
Please.
more domestic demand was more from a trade agreement perspective, not so much from whether we need to promote exports from getting into 25% of GDP manufacturing perspective. And the difference being that in a trade agreement context, for the person with whom you are doing that trade agreement, for him, India's domestic demand is a massive attraction. Because nowhere that the country is going to get the kind of growth that India is likely to witness. And I get it that for India per se to move from $3 trillion to $5 trillion to $10 trillion, domestic demand is not good enough. But from trade agreement perspective, it's always an imbalance that we have to deal with, that the other guy is always going to be in a slightly more advantageous position in bilateral trade agreements.
I do want to do a swivel round with, all of you and sort of get a sense of what you'd like to hear for the budget. But Chayon, I just want to draw you in on a more sort of human and individual element of this conversation, which is why do we always assume that more imports is bad for India or bad for Indians? Opening up the market, giving Indians and individual households access to more goods, perhaps better quality goods at cheaper prices, has not been a bad thing, has it? Why do we regard greater imports with so much suspicion? Because truth be told, it might have actually filtered down into better lifestyles for several individual households, or access to something that is cheaper for them.
No, absolutely. So the thing is that I think that is the reason of, it's a mercantilist thinking that imports are bad. And many countries have suddenly become very protectionist post-COVID. But I think the main reason is that our focus on exports, we somehow miss that imports are actually almost like a twin mirror of our exports, and especially in a globalized world with global value chains, uh, imports of certain kinds, intermediate imports, also imports of raw materials, these are things that should not be we should not import less. In fact, as far as India is concerned, these are the two items which we import more: raw materials and intermediates.
Yeah.
And I mean, it has an impact on our CAD, true, but we have to actually dissect our imports by these categories, and then understand that it is those imports are necessary. In fact, our capital goods or consumer goods imports are very small. Intermediate goods imports is about 70%, 80%. The rest is a large part is raw materials. Capital goods, consumer goods is only 5 to 7% of our imports. So where is the concern? I mean, at least from the exporting of it, I don't see where is the concern. And as far as your point is concerned about the providing consumers with better quality goods. In fact, interestingly, in the limited trade deal that we were about to negotiate with the USA, dairy was expected to be opened up, though we had problem with dairy in RCEP with Australia. And it would have meant that had we gone into RCEP, we would have got, at least for the dairy products, we would have got the Australian cheese, etc. I mean, things that our consumers could have enjoyed. And so from that point of view, I think your point is very valid.
I think we have some consensus around RCEP within this small group of ours. But just winding down to the tail end of our conversation, let me go to each of you turn by turn. Here we are. This is the reality of it. We do have these considerations around an Atmanirbhar Bharat, but we do understand that exports have to be a primary tool for growth. Let me ask you what you would like to hear from the finance minister just with regards to the export-import issue in her speech. Dr. Ranade, let me start with you and then I'll go around to the rest.
Well, surely we have to match the ambition with action. So if we want manufacturing to be going up from 17 to 25% of GDP in the next 5 or 7, 8 years, then that cannot happen unless our exports also do well. This is a truism, Italy.
Yeah.
We have to accept that. And we need to do whatever it takes to increase exports. And that should be like almost a high priority mission. So, for example, the finance minister, she should earmark considerable amount of resources towards this thing. Now, it could be in the form of this ROTTEP, I think it's called, which is replacing MEIS, the Manufacturing Export Incentive Scheme. I don't know how successful it was, but apparently it's consuming 50,000 crores today. So it's not a small amount. And that's going to go away. That's going to be discontinuing. So whatever is coming in its place, more smartly designed, that certainly, I think, would be essential. I think we need to also find ways to encourage value chain locations into India. And if that means also there's, one of the things that was discussed at length was the fact that we have all these small firms and they don't grow possibly because of the labor law, the firm size beyond 10, it suddenly drops off. And that's where we suffer because we can't have scale. So I think that's something that the budget could look at. This is not the time to make a wish list, but just one point about that exports are very important. For 5 years, we neglected them, and therefore a considerable amount of resources towards that. And not to forget the currency policy. I think the exchange rate is also important in this story.
Absolutely. Santosh, I don't reckon the finance minister will stand up and say, well, hey, we've got these tariffs going only for China, because that would create significant trouble with the WTO. But, what would you want to hear in terms of what she says and what she puts in place? As you said, talk has to meet action.
Mitali, I think this budget should do two things. One is it should introduce a lot of nuance into all these stated objectives. What is Atmanirbhar? How do we attract FDI? How do we promote exports? So we need a lot of nuance around it. And if you're afraid of imports, we can impose standards. One thing nobody realizes is in the beginning, Dr. Ranade said we are dependent on China for 80%, 90% of some categories. Now, the real fact is we are dependent on that because we have no standards. So whatever is manufactured of low quality, like toys and so on, comes into India, with an open gate. So we need to start erecting standards rather than tariffs and improve the quality of the imports. And simultaneously, this will encourage domestic manufacturing, whether by Indian companies or foreign companies. So I would like to see a lot of nuance around all these ideas, and a little bit, I think, to some extent, some damage control is required, because today a foreign investor is getting very, very confusing signals. And there are many ways we can do it. Just yesterday's incident at Winstron's factory in Bangalore, where laborers attacked and stole iPhones and ran away. So we need to really get our house in order. We need to have a clear signaling which is consistent, which is backed with political will. We can't have a hedging approach where we project an image to the global world about ease of doing business, welcome to India, make in India. And when we have a domestic audience, we start talking about self-reliance. We don't want to import, because this is just confusing and it's not going to serve anyone's purpose.
So standardization, currency policy, manufacturing front foot forward, export policy. Samiran, do you want to add to that? Do you want to embellish that? What would you like to hear?
So first, I think let's admit it that once you have embarked on this self-reliant India campaign just 8-10 months back, I don't think we can completely change the course or the philosophy behind it so quickly. So at least for this year's budget, my sense is that most of the announcements will be in line with what we have heard in the recent past. And in that context, I think if you look at the overall government spending and break it up into how much goes to different industry-related ministries, and if you take out defense out of it, only 5 to 6% of total expenditure goes to all the ministries which are involved in any industry. That's, in my view, a very small number which needs to go up. And that's where the allocation towards these production-linked incentive schemes, etc., will be very important. And let's also face it that we have, at a very top-down level, announced these schemes, but their effective implementation will very much depend on the granularity of the schemes that are going to be announced over the next few months. So we have to finish this process well. The second aspect is with respect to the tariffs and all. My suspicion is that we are not going to see any rollback in tariffs. The only thing people who are pro-trade can hope for is that there is no further increase in tariffs in a big way. But beyond that, I don't think anything is going to happen on that front. But I guess the bigger point, and I always go back to it, is that if India's industrial sector has to grow, then the infrastructure support needs to be much, much better. And that's where if the government shows a substantial increase in infrastructure spending, and not just the traditional roads and railways, but maybe a much more wider variety of infrastructure spending, that itself will be a big positive, because in a sense, infrastructure spending not only supports growth, it's growth in itself, the kind of jobs and linkages that it creates, that can feed into this whole industrial recovery that we are thinking of. And one last point I want to make is that after a very long time, we have got the right preconditions for private capex to grow. We have got corporate profitability to go up. We've got very low interest rates. We've got very low tax rates. And we have seen that financial leverage of companies are coming down. So it's probably the best time to give the push to industrial development and get this private capex virtuous cycle to start forming. So in that sense, this budget is going to be very, very crucial for me.
I sincerely hope India Inc. is listening, Samiran. You're absolutely right. It's never been an opportune time, but if not now, then when? But that's a good dose of realism. Saon, no rollback in tariffs, believes Samiran, but perhaps a status quo on any fresh tariffs. What's your own sense, or what would you like to see rather in this budget?
So you saw the foreign trade policy has also to be unveiled. I mean, we had it till 2015 to 20, and we are expected to see some of that at least there, which would be actually setting out for the 5 years what would be our export targets, etc. Now, the main problem that we've had is that our approach towards exporting and manufacturing has been very piecemeal. And we actually need to link all three together, our trade policy, our industrial policy, as well as our technology policy. And we have not done that. Plus, it has been erratic, as Santosh was also pointing out. So, what we need is a approach that is consistent and holistic. Some tariff rollback or that's a very temporary kind of thing. And but the PLI, for example, it is expected to be a small, a short-term measure, because any measure of this kind, if it is continued for the long term, would actually again give rise to inefficiencies, and it's not the best way to promote manufacturing.
Absolutely. Excellent points and such an engaging conversation. Thank you very much, all of you, for your time. We wait and watch, a month and a little bit to go before the union budget, but we're just trying to set the stage in terms of what the important pillars will be. We hope you enjoyed watching this. We'll be back again next Monday with another important point of focus. To all my guests, thank you very much today for joining in. Goodbye.
Thank you. Thank you.